My name is David Penn. I'm a research analyst at Finovate, along with my colleague Julie Moon, who I hope you got to see and enjoy a few moments ago. What we're going to go ahead and do is I'm going to have my panelists go ahead and introduce themselves briefly, just so you get to put a name to a face, and then we're going to jump right into some questions that we have. We have more questions than we have time to cover, so we're going to do that, but we also know that you might have questions as well, so we're going to try to keep an eye open to make sure that if there are any concerns or thoughts that you've got as our conversation unfolds, that we can address those as well. So, without any further ado.
Hi folks, I'm DC Cahalane. I'm a partner at a UK and Ireland VC fund called SVV. We've been investing exclusively in artificial intelligence technologies since 2017.
Great. Hey guys, Robin Scher. I work for Lloyds Banking Group in our CVC, so Series A, Series B investor.
Hi everyone. My name is Sohiba and I work for InsurTech New York. We are insurance specialist VC fund investing in US, Canada, and UK, and we invest at seed stage.
Hi, my name is Sophie Winwood. I've been a fintech investor for the last 7 years, mostly pre-seed. I also angel invest. I also run a company called Unlock VC, which is a community and platform for women in VC.
Fantastic. So again, as you can see, we have incredible diversity across the landscape of venture capital in terms of fintech. So let's go ahead and jump right into it. And we'll come down the line this way, at least this first time around. I want to talk about macroeconomic headwinds, sort of a big picture maybe to start with. There's obviously economic trends, there are political trends, regulatory trends, things like that. How are some of these trends impacting investor sentiment in terms of fintech? Which are the ones you find most salient for yourself in the work that you're doing? And DC, we'll start with you.
Oh, cool. Look, I mean, obviously I'm biased. We're an AI investor. But what I will say we've noticed a lot is a lot of confusion, in particular, I think, in fintech, because a lot of people are confusing AI as a technology trend and not a technology wave. So we're living through a bit of a hype cycle at the moment where people are kind of going, oh, you know, there's a lot of negativity around AI.
Indeed.
But the reality is, you know, the way fintech needs to think about AI is the same way they thought about the internet or mobile banking. You know, it'll be, you know, AI is the thing where in a couple of years it'll be a bit like nobody would get on stage and say, we're a cloud startup. But what we are seeing is, you know, there is obviously still some skepticism in, you know, large financial institutions around the use of AI. But actually, I think this year will be a breakthrough year because, you know, towards the end of last year, we kind of broke that skepticism that existed in terms of the use of AI in healthcare. And now if you're seeing wide-scale deployment of AI in healthcare, so if it's cracked that kind of safety barrier, I think this year could be the year that we'll see significant deployment of AI in large-scale financial services.
Interesting. Robin.
So macroeconomic headwinds. So I think we've seen quite a lot of macroeconomic tailwinds for quite some time. Like the back end of 2025 into 2026, I feel like the economy has been kind of going okay. Certainly the market's been going okay. You mentioned political uncertainty. I mean, things have been happening very recently. There's obviously political uncertainty in the UK. Very unclear as to how that's going to fall out into the kind of VC world. I don't think it will touch it too much. I think what we see at the moment is probably getting towards a more frothy market than we've had since 2021. And I mean, I've certainly been seeing term sheets recently that are quite eye-watering and like way beyond what I was seeing in 24, 25. So I actually think the macroeconomic, I would say we've actually seen quite a lot of tailwinds to get us to this place. I actually think that we might see things ease off both in the markets and probably that will have an effect on wider VC funding in 2026. Things might ease off by 20% in the markets perhaps, and let's see how that affects VC funding. It might do the opposite. It might actually promote more VC funding as the markets head off.
Interesting.
In insurance, we have seen several trends. So one of them is big carriers, like big insurance carriers, started implementing AI, but in a specific, let's say, back office operations. We are talking about 150 years of legacy data. And of course, there is so much you can do. So in terms of underwriting, it's been used. In terms of claims management, in terms of loss runs, but none of the insurance companies are putting AI as a sales agent. They have a chatbot, but usually it's it's people. But at the back office, that's where the most investment is going. And the second trend, unfortunately, due to last year's events and the 2024, there was a lot of climate natural catastrophe events in the US and also worldwide. And obviously, it was a huge loss for insurance carriers. But like, for example, in states like California, they just scaled back. So it's very difficult, however rich you are, to get insurance for home because there is so much wildfire risk. So now these insurance carriers, what are they considering as a trend is that they are using these very advanced AI and satellite-based technologies called NatCat models. And these kind of startups are popping up, which help them to forecast some of these events. And that's actually, we are seeing that this macro event caused this kind of innovation. Yeah.
I think the only thing I would add is, obviously, as a sector, venture capital is impacted as much by macro as the underlying kind of fintech and financial services, and that is having a knock-on effect into the funding that's available for startups. We know that there's been not that many exits, IPOs, and M&As over the last couple of years, which has meant that LPs, or the investors in VC funds, are not getting their cash back at the rate that they would expect. They've also had a relatively, if they're an LP that's diversified, not had a great time in the public markets as well. And so we're seeing less capital flow into venture capital funds that therefore is available for startups. However, I think what is interesting is these kind of niche startups that are vertical specific, or CVCs who aren't reliant on this fundraising cycle still have a lot of capital available. And we do know that banks and insurance companies are some of the most active CVCs industries. And so I think that means positioning fintech as actually quite an interesting place to be in this kind of macro environment.
Interesting, interesting. I want to talk, maybe take a step off of that a little bit, talking about trends, some of the more common trends, but both in terms of trends that we expect to endure in 2026, and maybe some that enter 2026 that might not make it out of 2026 in terms of their popularity. I'm thinking of things like embedded finance and some of these others. And Sophie, if we could start with you, maybe we'll come back down this way. What are some of the trends that you think in 2026 are likely to endure or even intensify? And at the same time, if you can, trends that you think maybe not totally played out, but maybe have had their run and maybe you're going to take a bit of a pause this year?
Yeah, I think if you take the embedded finance kind of trend, I feel like we've been talking about embedded finance for like years, maybe like 10 years. And we started off with this super broad, like it will just be an infrastructure and you can embed any financial services product into any other platform. And then everyone realized that's kind of insanely complicated because every industry has their nuances, every customer has their different ways of acquiring and different risks are underwritten. We need different types of data. Embedded finance is here to stay. I think we all agree that. And what's really exciting is you're seeing like this like niche industry-specific embedded finance where you're getting really interesting data for underwriting. You're getting just like differentiated distribution. And so I think that is very much here to stay. Like our favorite thing, InsurTech is back. I feel like it had a bit of a lull over the last couple of years, but because of interest rates rising, InsurTech and also lending is also becoming increasingly interesting. I think what's on the back burner, something that I came on stage last year and shouted big about was tax. I thought that was a really interesting opportunity. I think that's been kind of played out a bit now. We had a lot of companies come into the market attacking tax and finance and accounting from various different angles, and I think it's a little bit saturated, and I think we need to like chill out there for a little bit.
Interesting. So Kiva.
I agree with my colleague that I'm actually happy to see that InsurTech become the next thing, and people are actually asking me sometimes. So what I'm seeing in terms of being embedded in insurance, for example, one of our portfolio companies, they are providing life insurance and also income insurance through distributing it through apps which are for budgeting. Okay, so this is actually, they are embedding within that app, so people who are having a budgeting or saving for mortgage know that there is an income insurance which you can buy yourself. So this is like one of the examples of being embedded, and we are seeing more of these super apps being like even property companies are embedding the insurance, so every mortgage embedding the insurance. So I could see that being that they are seeing that this is actually a potential revenue generator, and it's true. One of the things which I'm seeing which become a bit saturated is ESG reporting. So for example, we see a lot of technologies who are trying to capture the climate reporting and CO2 and everything. So this is like, and some of them are connected with fintech. They're, for example, for banks, the regulatory. I'm seeing that because there are so many of them, it's become very competitive market. So I think there will be either consolidation, like some people will be buying each other, or some of them will just pull out of the market because it just becomes so difficult to be in this market.
So prepare for some main character energy here. Just hearing about InsurTech from both the previous panelists, I am the reason why InsurTech came back last year. And the reason is, 3 years ago, I got asked this question on a panel, and I was like, yeah, InsurTech, this is the year for InsurTech next year. 2 years ago, I got asked, I was like, yeah, this is the year for InsurTech. And last year, I was like, you know what, I'm not going to look like a mug again. I'm not going to say it. I'm done with InsurTech. It's probably never coming back. And now it comes back. So yeah, it is purely just my awful predictions 3 years in a row. So yeah, very happy to see it back. I would say digital assets will endure for sure. Like I think just more and more, especially institutional grade, it's going to be used more and more. And I think kind of building on the sustainability angle, I agree. I think it will fizzle a bit, but only the ones that are really, this sounds really awful saying it, right? But the ones that are really going out expecting people to invest as a force for good. I think there was a time where people had the ability to invest as a force for good. I think right now people want to see the pound notes being returned, partly because of lower returns across the board for other things. So if there is a company that is looking at something like sustainability, they have to really understand how they're also going to make money. So it's that kind of joining up there.
Yeah, I guess I agree with all that, so I won't repeat that. One of the things that we saw a lot of at the end of last year was in a lot of financial services areas, we saw a lot of companies building very, very niche, we do this tiny fraction of a thing in the technology stack of a financial services company. We don't do the loan diligence, we do this tiny part of it. I think those companies are going to find it really, really tough because I think it's getting, for encumbrance, it's getting easier now with a whole bunch of AI coding tools, getting easier for internal teams to build these kind of little add-ons. So I think if you're building something in the space, it needs to be kind of substantial. The thing that we're seeing an awful lot of at the moment is, as a former enterprise sales guy myself, my whole life was pretty much as a kind of a CRO, and optimizing for revenue in the fractions of percentages. And we're seeing a lot of that in financial services now, where because you can have much cleaner data sets, because you can now, using AI and other tools, you can afford to do microtransactions on stuff. We're seeing a lot of kind of this almost revenue optimization grade activity where we may process that transaction using that merchant, we may do this transaction using a completely different merchant because we get a fraction of a fraction of a fraction of a percentage back. So I think even a brother who's a partner in a law firm here in London is seeing the same thing. A lot of the technologies they're being pitched are not like how to optimize life as a lawyer, but rather like how do they optimize pricing and how do they optimize that. So I think we're going to see a lot of that optimization layer come in now that AI kind of enables these sort of microtransactions to a lot better degree.
Interesting. One of the things I find sort of compelling about these conversations isn't just sort of the trends and some of the abstractions, but the human people behind these institutions and these organizations and businesses. So I want to talk a little bit about founders. And one of the things I'm curious about, obviously you're in contact with founders, you're meeting, talking with them, even those you don't end up working with, you're still talking with so many folks. And one of the things I'm curious, and so Kiva, perhaps we could start with you on this one and work our way down the line. What are you hearing from them in terms of some of the challenges that they're facing, whether it's things like funding issues, regulatory hurdles, talent acquisition, and sort of the competition for talent? What are some of the concerns that you're hearing from them?
Well, I think it depends, but of course there is a challenge that one of the challenges which was last year that the the fundraising cycle got longer. So let's manage expectations. When the founders start, they got to say, oh, I will raise it in 3 months and that's it, and I will be back to business. And it takes now up to 9 months sometimes, depending on how complex thing you are building. And because the VCs become a bit more pickier, and it takes longer. So for complete stranger to give you money, you need to build a relationship earlier. So those who are smart enough to have an investor list, so for the founders here in the room, I would suggest start building your investor list earlier with the people you met, start creating investor newsletters. Like, the more you have people already in your network, the faster will be your fundraising. That's what I'm seeing. And another challenge is, of course, regulatory, that you need high capital adequacy amounts. But there is some, like another angel ticket, what they did, they borrowed the license. And they recently launched a digital bank with a big bank as a collaboration, because they basically borrowed their license, because otherwise they won't be able to launch. So I think in UK we still have founder-friendly environment. We have grants, but for example, in US, some of the founders are finding challenging scaling because each state has a different licensing rules. So my another advice will be, do not scale to US too early.
Interesting. Sophie?
Yeah, I think something that's been always a big problem in fintech and feels even more at the moment is the sales cycles. And I think it's never been easier to build a product. So really distribution is key. And I think given the volatility over the last couple of years, you're having, Robin, close your ears, banks sort of like move forward in innovation, then pull back, then move forward and pull back. You're having stakeholders move around, and so it can be very difficult to navigate your way through large organizations, and that's why I think you're seeing a lot of fintechs start with other fintechs and sell to fintechs, and then build up. But actually, you know, everyone wants to work with the banks. They have the largest data set and distribution and customers, but you know, you have to be willing to sit through these large sales cycles.
Interesting. DC?
Well, I feel like a bit of a cheat here, because the last time I was at Finovate, I was here as a founder. So I've spent 3 years as a VC. I spent 21 years as a founder with 4 exits under my belt. What I will tell you, the biggest thing that I've learned in the 3 years since I went to this side of the table is I do agree with you completely. I think the fundraising process for fintechs and for founders in general can be a very misunderstood entity. I've never felt so much like a bank manager than when I became a VC, and you have founders coming to you kind of pitching you for a loan. And it's, I think one of the one piece of advice I always give founders is, like, you know, if you're a serial founder, you can go out and you can raise pretty much any money you want on any terms, because the one thing that's been established is your track record in managing an investor's money. If you're a first-time founder, that sort of relationship building that you're talking about is so important, because, you know, if your credit was good, you'd go to a bank and borrow the money. Your credit isn't good, so therefore you have to relationship build with the people who you're expecting to dole out, you know, hundreds of thousands of millions. So that's the biggest piece of advice I give to every founder I meet, which is, like, VC is a relationship game, like, and you're trying to you're not trying to find the cheapest money, you're trying to find the best partner, the people who will be with you on the journey for the next 6 to 10 years of your life.
Excellent point.
Yeah, and actually, yeah, just to build on that, because I think that's really valid. And I think a lot of the key points have been mentioned. Completely buy into the fundraising and the sales cycle. God, like, everything you're saying, like, working for a bank, it's triggering and it's jarring, and it's so true. And actually, there's another element as well where the banks say, actually, that's really good, we'll build it ourselves, and spend 2 years trying to build it, and then come back to the same person that pitched it and said, actually, you were better than what we thought we could build. So yeah, it's definitely true there. And then from the money perspective, you get 2 things. You get one, which is the founders that just have to take whatever money they can get, and then you get the others who get the choice. And it's so easy to get your head turned by that VC at the moment, often out of the States, who is willing to almost just put another zero on the valuation, and they're like, and people are like, yeah, well, I'll just go with that then. And I'm not here to say whether that's right or wrong, but it's dangerous.
It's wrong.
Yeah, and it's wrong. It's dangerous and it's wrong. I am here to say whether it's right or wrong. It's dangerous and it's wrong. Yeah, and it's and that's certainly one of the things. And then talent, you mentioned. Talent's an interesting one because I might flip that on its head slightly. I think what they've got at the moment, some of the let's say Series A, Series B have built out great teams of people who they're suddenly now realizing they might not need as much as they thought because of the incredible tools that they might have even partly developed themselves. And that becomes quite difficult when you've built a company from the ground up where you might have a team of 30, many of whom you consider your friends because you've built the company with them, and you actually suddenly realize that you might not need a team of 30 to scale anymore. Difficult conversations to have.
Absolutely. And actually, the point that you just made there sort of dovetails with a question that just came in, talking about the relationship between potential increases in productivity due to AI and coding, as I mentioned, affecting the ability of scale-up startup teams and VC investing. And it seems to dovetail a lot with what you're talking about right now.
No, yeah, absolutely is. It's as soon as someone puts a kind of pitch deck in front of you now, it is around like, well, we don't think we need to scale. We don't think we need a lot of people. We can do this on a shoestring budget, and it's and no one is imagining these kind of grand teams. And genuinely, who knows whether or not that will be true? So, I mean, let's be honest. Financial models in early stage pitch decks don't really mean much anyway. But when you're saying we're going to be able to just cope with our founding team and 3 other people for the next 5 years, you kind of look at it and raise your eyebrows and then think, I don't know, maybe.
we are seeing, though, like I would say, I can't say this for definite, but I think our average check size in 25 was probably half the size of our average check size in 24, because actually the companies are coming looking for less money, because actually they look more at like what it's going to take them to get to MVP, what it's going to take them, and they realize like we need less human beings. And obviously in any early stage funding round, pretty much all of the money you raise is going towards labor. And we're actually, the interesting thing we're seeing it as like the founders just wanting to avoid more dilution. So especially at pre-seed, they'll happily take 500K instead of $1 million, see how much they can get done for that 500K using Cursor and all these tools. And then if they've kind of made the wrong bet, they'll obviously still have built a great product and still try to go out and do quite a chunky seed, But yeah, it was kind of a surprise to us, but it does mean that, this year we'd expect to write twice as many checks, just at half the volume, or half the amount.
Yeah, interesting.
But I do think we're seeing this like bifurcation in the market of companies that are raising less, doing more with less people and accelerating very, very quickly on one side, but then you're also seeing this other a load of companies, especially in kind of sustainability, who need more patient capital and are staying private for longer. And I think we as a VC industry need to evolve, because we've been our model has been the same for the last 20, 30 years, but actually the nature of the underlying assets that we're investing in is completely changing. And I think there is room for like a change in our own business model.
Yep.
And then we're also seeing on the third side of the 3-sided coin that I've invented, we're seeing the startups that are raising like a Series A round of $125 million at a $1 billion valuation, which is one that I saw last week. And you're just like, what are you using $125 million for?
That's going to be some Christmas present.
Yeah, it really is, isn't it?
Yeah, in terms of, for example, in terms of talent, I agree with you that people got, well, especially we invest 70% in US, but I could see it across the globe. People got, I would say, scrappier. They become a bit more, they try to squeeze every money because they try to bootstrap further along to have a higher valuation. And that's what I actually suggest, that if they could, however they can, to go at least to early revenue, that will increase their valuation, because raising pre-revenue, the valuation is usually in UK is less than $1 million. But if you have early revenue, then it will be higher. So I always suggest actually like UK grants, competitions, however you can do, and that's what people are doing. Because, for example, in 2021, everyone wanted more money. Now they are a bit more like, no, we don't need that much. We would like to stay lean. And we are seeing in the US that 2-people teams are building fully AI agent-driven tools for, let's say, for insurance. you will be surprised that everything is running, and they have built like 50 AI agents to capture all supply chain, and you see it like, so the person needed only at the end to review and verify. And that's what people are building with revenues and everything, couple of people teams. And this is what we are seeing, and I think we will see more of this.
Agreed.
Interesting development. We're just about out of time, but I did want to ask one sort of last round question, sort of something for all of us to take away from the conversation. And okay, we'll start with DC and we'll work our way down the line. Give Sophie the last word. What technology do you think that we're going to be talking about at the end of the year that you're going to think is going to be the major trend that we're going to be talking about by the end of the year?
It's obviously going to be AI, but I'm going to be specific and say
Yes.
multi-agent architecture.
Okay.
So you heard a lot of last year about agentic frameworks and stuff, which was marketing BS, but I think this is going to be the year where companies are going to start getting comfortable letting agents talk to other agents. You're going to see a kind of a workforce element come into kind of how companies deploy AI.
Interesting. Robin?
I mentioned it earlier. I think institutions are going to start using digital assets more, the big financial institutions.
I think what will be the next trend, especially in insurance and fintech, is that people will start building specific AIs for specific matters. So they will get, let's say, layer more deeper in terms of accuracy, and that's what people will be looking, that I need that you are solving one problem, but you're solving it well. That's what, because there are some AI agents, they say, we do everything. I think the more we see is that they are becoming very, very niche and specialist, and that's what people want.
Excellent. And Sophie, to finish it up?
I mean, they've all smashed it. So I think the only thing I would add on the AI frame is regulation being a moat rather than a barrier, and like how you can kind of now codify regulation and compliance into technology. And I think there was a time when RegTech was cool, like 15 years ago, and then it all became like really not cool when everyone was like, it's too difficult. And I think given the advances in AI, we're now going to be able to see some really interesting applications in the like unsexy area of RegTech.